Introduce. My name is Widya Oktafitriani, Accounting Class 23 ANPM 234122022. In this video, I will explain the material about markets and financial institutions. Definition of Financial Services Authority. The Financial Services Authority is an institution tasked with supervising and regulating activities in the financial services sector, such as banking, capital markets, insurance, pension funds, and financial institutions. OJK was formed based on Law No. 21 of 2011. OJK has the functions, duties, and authority to regulate, supervise, examine, and investigate activities in the financial services sector. The function of the Financial Services Authority. OJK functions to organize an integrated regulatory and supervisory system for all activities in the financial services sector.
Duties of the Financial Services Authority. Based on Article 6 of Law No. 21 of 2011, the OJK's main task is to regulate and supervise 1. Financial services activities in the banking sector 2. Financial services activities in the capital market sector 3. Financial services activities in the insurance, pension fund, financing institutions, and other authority of the Financial Services Authority. The authority of the OJK is as follows. 1. Specifically related to the supervision and regulation of bank financial services institutions, which cover a. Licensing for the establishment of a bank, opening of a bank office, articles of association, work plan, ownership, management and human resources, mergers, consolidation and bank acquisitions, as well as revocation of bank business permits. b. Bank business activities, including sources of funds, provision of funds, hybrid products, and activities in the service sector. C. Regulation and supervision regarding bank health, which includes liquidity, profitability, solvency, asset quality, minimum capital adequacy ratio, maximum credit limit, loan-to-deposit ratio, and bank reserves, bank reports related to bank health and performance, debtor information system, credit testing, and bank accounting standards. D. Regulation and supervision regarding bank prudential aspects, including risk management, bank governance, know your customer, and anti-money laundering principles, and preventing the financing of terrorism and banking crime, as well as bank checks. Point 2. Regarding regulation of financial services institutions, banks and non-banks, which cover a. Establish OJK regulations and decisions. b. Establish regulations regarding supervision in the financial services sector. c. Establish policies regarding the implementation of OJK duties. d. Establish regulations regarding procedures for issuing written orders to financial services institutions and certain parties. e. Establish regulations regarding procedures for appointing statutory managers at financial services institutions. f. Determine the organizational structure and infrastructure, as well as manage, maintain and administer assets and obligations. G. Establish regulations regarding procedures for imposing sanctions in accordance with the provisions of laws and regulations in the financial services sector. Point 3. Regarding supervision of financial service institutions, banks and non-banks, a. Establish operational policies for supervision of financial services activities. b. Supervise the implementation of supervisory duties carried out by the Chief Executive. c. Carry out supervision, inspection, investigation, consumer protection and other actions against financial service institutions, perpetrators and/or supporting financial service activities as intended in laws and regulations in the financial services sector. D. Give written orders to financial services institutions and/or certain parties. Appoint statutory management. F. Determine the use of statutory managers. G. Establish administrative sanctions against parties who violate laws and regulations in the financial services sector, granting and/or revoking business permits, individual permits, effective registration statements, registration certificates, approval to carry out business activities, ratification, approval or determination of dissolution, and other decisions. Definition of monetary authority. The monetary authority is an institution that has the authority to control the money supply and set interest rates. In Indonesia, the monetary authority is Bank Indonesia, BI. BI has an important role in maintaining the stability of the rupiah value and supporting sustainable economic growth. BI has the authority to set monetary policy and banking-related policies, such as interest rates and liquidity. The main functions and tasks of the monetary authority. The following are the main functions and tasks of the monetary authority. 1. Controlling inflation. The monetary authority sets an inflation target and takes the necessary steps to achieve it. They use policy tools such as interest rates, open market operations, and mandatory reserves to influence inflation rates. The aim is to maintain people's purchasing power and price stability. 2. Maintain exchange rate stability. The monetary authority can intervene in the foreign exchange market to maintain the stability of its currency exchange rate against foreign currencies. Exchange rate stability is important for international trade, foreign investment flows, and domestic inflation. 3. Regulate the money supply. The monetary authority is responsible for ensuring the amount of money in circulation meets the needs of the economy. The amount of money in circulation affects people's purchasing power, investment, and consumption. Monetary policy tools such as interest rates and open market operations are used to regulate this amount of money. 4. Regulating and supervising financial institutions. In some countries, monetary authorities also have a role in supervising financial institutions, such as banks and other financial institutions. This supervision is carried out to maintain financial system stability and prevent financial crises. 5. Providing last loans, lender of last resort. In an emergency or financial crisis, the monetary authority acts as a lender of last resort for banks or financial institutions experiencing liquidity difficulties. This aims to prevent a wider financial crisis. 5. Providing last loans, lender of last resort. In an emergency or financial crisis, the monetary authority acts as a lender of last resort for banks or financial institutions experiencing liquidity difficulties. This aims to prevent a wider financial crisis. 6. Support financial system stability. Monetary authorities work to maintain the stability of the financial system as a whole. Apart from supervising and regulating financial institutions, they also conduct studies and analyses of risks that could threaten the stability of the economy and financial system. The monetary authority has several monetary policy instruments to carry out its functions. 1. Interest rates. One of the main ways to control inflation and economic growth. By raising or lowering interest rates, monetary authorities can influence people's consumption and investment. 2. Open market operations, buying or selling securities, such as government bonds, to regulate the money supply. 3. Mandatory reserves. Reserve requirements determines a certain percentage of bank deposits that must be kept at the central bank. This affects banks' ability to provide loans. That was from my video. What I can convey more or less. I apologize if there are any wrong words. I hope it's useful. Thank you.